Good morning, my name's Michael Pate. This is the Killik & Co podcast for the 17th of October. We start with a cartoon which exhibits the changing scenarios that we were talking about last week, where markets have got increasingly less worried about rates going up and more worried about deflation. That's shown in this chart, which is the 5-year, which is basically showing expectations for the next 5 years of inflation in 5 years. And as you can see, down at 1.7, they're well below the 2% target. Chart of the week for us was the very big move on Wednesday in the US Treasury 10 yield. In 3 hours, the Treasury yield fell 13.5%, which, given it's the most liquid market in the world, was quite a move and sent the hairs running on a number of markets, only to rally back over the rest of the week. So this is symptomatic of a lot of stop losses being triggered and tends to sometimes be the bloodletting that markets need before they can move higher again. So what does the price action raise in terms of questions? Firstly, what we're seeing at the moment is there's some givens in the market about normalization of economic activity will lead to higher interest rates. Is that actually going to happen? Secondly, does the unprecedented level of monetary expansion in terms of QE actually mean that we're going to see inflation further down the track? And again, that was a given in markets. What we're currently going through at the moment is a reconsideration of that and a growing awareness that there are some very strong deflationary trends in the economy. So falling commodity prices is one, and one needs to look at the reason that these commodity prices are falling. We'll go into that in a bit more detail later in terms of the supply side issues. Secondly is the availability of labour. Thirdly is technology, and we can see it in our everyday lives and certainly in food retailers that there is an Amazon effect that the internet is creating for prices. So what we're looking for is we're trying to examine whether deflation is actually something that can exist while we are going through a period of economic normalization, and therefore not quite as scary as that monster in the cartoon at the start would suggest. So the key macro events of the week, this week, have been firstly the ZEW German business confidence, which was very poor. That was a really poor number. We had some US retail sales, slightly disappointing. And then slightly more positive, Chinese import-export data was better than expected. We had a good Philly Fed survey number, and I'll explain what that is. And we had pretty solid US jobless claims, which continue to fall. So the Philly Fed is a good gauge of the US economy. The Philadelphia economy, 7th biggest economy in the US. It's a very good gauge for manufacturing activity in the US, and that was better than expected. Still coming off a very strong period, but still better than expected. And again, here we have the US jobless claims, which you can see have continued to fall steadily, which is a good sign of a healthy economy. On the negative, the German ZEW business confidence number was really poor. That came in a long way short of expectations. And we'll go on to talk about that in due course. Key company events for last week, US reporting season. So far it's been okay. 57% have beaten on revenue and 78% have beaten on earnings. That is sort of what you'd expect in this kind of environment where growth has been hard to come by, but margins have remained high. And companies continue to buy back more of their shares, enhancing their earnings per share. Rolls-Royce this morning had a poor revenue guidance number. They warned because of Russian sanctions hitting their power delivery businesses, nuclear power. AbbVie are looking to walk away from the Shire Pharmaceuticals deal that came earlier in the week because of tax inversion issues. It's obviously politically difficult at the moment. And Google had a small miss last night. The average cost per click, which is something we look at pretty closely, came in slightly lower than had previously been the case. So going back to the deflationary issue, because that's what's really focusing people's minds at the moment, we look at the current weak oil price and what's that telling us, because often it's perceived as a weak global economy. What we're trying to say here is that there are some other issues to look at. And firstly, we've seen a big acceleration of non-OPEC exploration and production capex, which has meant that more non-OPEC supply is now available in the market. Equally, shale oil in the US is now delivered a huge amount of oil to the market, and that's taking up a lot of the increased demand that a growing economy is stimulating. Thirdly, there's a US dollar effect. So as you can see from this chart, as the US dollar appreciates, the cost of oil for those people in currencies outside the US dollar goes up, and therefore demand goes down, and therefore there's an inverse correlation. Equally, on the demand side, you've got a decrease in demand for oil, not necessarily a sign of a falling economy or a poor economy. And that's sort of increase in renewables, alternatives, increase in fuel-efficient vehicles, which are a big source of demand for oil, and obviously Chinese economy shifting from industrial production to domestically consumer focus. So the other issue that we've seen this week is signs of more stress in the Eurozone, principally in the Greek yield, which is now above 9%, but we've also seen it in the Portuguese, Italian and Spanish yields, which have been going up as people get more worried about their credit situation, and the German yield, which is going down. So can we expect this to continue, and are these concerns valid? Well, they are valid to a certain extent. So 25% of Europe's is already experiencing deflation. So that suggests that even though yields are very low, real yields are still too high. We've also got an over-reliance on the German economy. And the German economy, as we know, is 2/3 reliant in terms of their GDP on exports. So you've got a situation where Germany is very, very tied to what the Chinese economy is doing, and that's an uncomfortable situation. So what do they need to do about that? They need to stimulate domestic demand, and that's something that we haven't seen. So while bond yields have gone down, the ECB has, in theory, bought some time for governments to sort out their countries, their economies, and start stimulating domestic demand. But we haven't seen that restructuring, and we need to see economic growth to sustain the current debt situation. So what are the choices? What are the markets looking at in terms of how this is going to be solved? Well, it's either a breakup of the European Union, which would be extremely expensive and I think is not in many people's interests, or it's more aggressive monetary policy. That's the road that we expect to go down, which would be a positive for the market. But evidence would suggest that you need more volatility before the ECB or the German administration would allow the ECB to step in and be more stimulative with more aggressive monetary policy. So given the concerns around in the world, does the equity market represent good value? We think it does. This is a chart which shows what we call the equity risk premium. That's the premium of return you're getting over the risk-free rate for buying shares. And as you can see here, it's very high by historic standards because that's the gap that we're looking at. That's the 10-year risk-free rate, and that's the excess return you get for owning shares. So we think a lot of these risks are already priced in. And as a result, we've been moving, sorry, this is a poor chart, we've been moving more money back into some of our favourite stocks that we think are insulated from a lot of the issues that are out there. So structural growth stories, US companies selling to US consumers, we still like, and where there's valuation support through yield or share buyback. So we've got Nike, we've got Visa, we've got Disney, we've got Google, we've got Merck, all stocks that you should be considering at the moment that have come back with this current pullback. So week ahead, we've got on Tuesday we've got a big week next week for China data. So we've got Tuesday Chinese retail sales, industrial production, GDP. Wednesday US inflation. Thursday HSBC Chinese manufacturing index, US retail sales. And Friday UK GDP. Again, another big week for reporting. Picked out a few here. Monday we've got Apple, so we'll be looking for iPhone numbers, average selling price. Tuesday, intercontinental hotels, impact of Ebola will be key. Whether the sharing economy and companies like Airbnb are starting to affect their market will be interesting. Wednesday, Whirlpool. And here we've sort of been looking at the average age of consumer durables, which in many cases are beyond their useful economic life, 16 years plus, relative to the very low levels of consumer indebtedness and thinking that should drive demand. So we'll see that. whether that's coming through on Wednesday. And then on Thursday, we've got Unilever looking for any of currency impact that's going to have on their overseas earnings. So that's the week ahead in its entirety. And finally, one chart to leave you with. What's been quite interesting this week is that the Russell 2000, which is the US small caps index, has been leading the market down all year. This week, sort of last 2 days, it started to outperform the broader index. That's a sign of growing risk appetite, and hopefully that'll steady the nerves of market participants, and that's a sort of canary in the coal mine for a better market going forward. Thanks very much. Have a good weekend.